Amoruso, and I'm an attorney here in Westchester County, and I'm thrilled to be presenting today on behalf of CarePrep, a division of the Westchester County Department of Senior Programs and Services. And today we're going to try to talk about a topic that many of you may roll your eyes over, but I'm going to make it as interesting as possible because it has direct relevance to you. And that's the new tax law that went into effect January of 2018. You've yet to experience it because you won't, quite frankly, experience it until you file your tax returns next April. But there's some key facts you need to be aware of as you plan for the rest of this year so that you're not surprised next year, especially for our seniors. So let's just talk briefly about how the law has changed in terms of tax brackets and other nuggets within the law. And then I'm going to take this into a realm of where it's directly relevant to you when it comes to your daily care plan and also your planning as well for trust and estate planning documents and things that you should be aware of as this law continues. But let's just start with the threshold. This is not a permanent law. This law is set to expire for individuals in 2025. So what we're going to discuss is relevant between 2018 through 2025, and the law reverts right back to the way it used to be under the old law. So first, let's cover some tax brackets. Under the old law in 2017, the brackets were 10%, 15%, 25%, 28%, 33%, 35%, and 39.6%. Those are the income tax brackets. Depending on what your adjusted gross income was, you fell within one of those brackets. That's been simplified by this new law a little bit, and there's been some minor decreases. So let's talk about what the new brackets are. The lowest bracket is at 10%, then 12%, then 22%, then 24%, then 32%, 35%, and then 37%. Now that's an important fact for you to know. You would think right off the bat there's going to be a substantial savings in income taxes because they've compressed the brackets a little bit. But if you can see, the lowest bracket at 10% remains the same. The 15% bracket did drop to 12% and the 25 to 22. But probably the biggest change is in the highest bracket of 39.6% in 2017 fell to 37%. Now, I want you to remember that the way your taxes are figured, it's not just based on your tax bracket. We also have to be quite mindful of alternative minimum tax because you do have to pay the highest of the tax, whether it's based on the tax bracket I just mentioned or alternatively a minimum tax. Now, there's been a lot of misinformation out there, and I want to make sure that you're very clear that the Tax Act of 2018 did not eliminate the alternative minimum tax. Instead, what it did was it increased the exemptions so that those that have now, if you're married, filing jointly, your exemption has been increased to $1 million. Now, that $1 million exemption means when the exemption amount for the alternative minimum tax, meaning the amount of money that you can deduct from your income before the alternative minimum tax is factored into play, has been increased. So that has now been increased to $1 million. If you're single, the exemption for the phase-out of the alternative minimum tax exemption has also been increased to $500,000. So if your joint or single income is less than $1 million if it's joint, or $500,000 if it's single, the likelihood of you paying an alternative minimum tax is substantially decreased with this tax act. If you're over those thresholds, then you could expect to still pay the alternative minimum tax. However, the exemption from your income has also increased. Back in 2017, the exemption for a joint filer, for example, was $84,000. So if you had to pay the AMT, the alternative minimum tax, the first $84,000 would be deducted in the calculation. That's been increased to $109,000. In comparison, if you're single, the exemption amount has been increased from approximately $50,000+ up to $70,000. So there is some helpful information there. However, let's now get into some of the areas of the new tax act that you need to be quite concerned about, especially if you live in Westchester County. Now, you may have heard the sound bites on the local news channels or the national network channels, but I want to be very clear here. Those of us in the Northeast are going to really feel the effects of a cap in the state and local tax deduction. So under the prior law, any taxes that you paid for state and local taxes, property taxes, school taxes, county tax, village tax, whatever the local tax was a permissible deduction off your income. So in some cities, that could be quite high here in Westchester County, your property taxes. This new law in 2018 now caps the amount that you're allowed to deduct to $10,000. So if you happen to live in a town or village where your combined tax exceeds $10,000, you are capped at $10,000 off your taxes. That will more likely have a corresponding impact on property values. Something else to consider here if you're a senior. We live on fixed incomes. Whether you're a working person or a retired person, your income can be quite fixed. So if you can't deduct what you deducted in prior years to make ends meet, that's going to have a corresponding impact on whether or not you can continue to afford to live in the environment you live in. So I highly recommend each and every one of you reach out to your accountants and understand the impact of the $10,000 cap on the state and local tax on your tax return bill, because it's better to make adjustments now before the year is over and you're surprised in April when your accountant prepares your return and tells you what is now due. Now, there are some other standard deductions that you need to be mindful of as well, and they include, for example, in the prior law, the deduction was $6,500 for a single person, for a single person, and $13,000 for a joint filer. That's been increased. So now the standard deduction is $12,000 for a single filer and $24,000 for a joint filer. One of the arguments in Congress as to why they capped the state and local tax deduction was that they were in fact increasing that standard deduction. So as you're meeting with your tax professional, please ask them to run the numbers for you to see if you are benefiting from the increased standard deduction or not. And I'll tell you why this could be very important, because if you are benefiting, we'd like to know about it. If you're not, we'd also like to know about it. And let me just give you a little bit of background about myself and how I've been involved with this tax law. So currently I serve as president of the National Academy of Elder Law Attorneys, and one of my jobs is to do intense lobbying down in Congress with regard to taxes and other issues that do affect seniors. Now, there's another part of this tax bill that when the House of Representatives last December released their version of the bill, it eliminated a provision in the 2017 law and prior that it was very beneficial to senior citizens, especially here in Westchester County. So the House of Representatives actually eliminated the medical expense deduction. Now, why is that deduction so important? Well, think about it. For folks that are empty nesters and have decided to sell their home, and instead, as they're aging, decide to move into an assisted living facility because they're tired of the maintenance of their home, they're tired of preparing their own meals, and they just want to move into assisted living. Well, under the prior tax law, that assisted living bill was fully deductible under the medical expense deduction. Why is that important? Well, many of us have saved up during our working lives, either whether it be IRAs, 401ks, 403bs, or retirement plans. And when you take your required minimum distribution from those plans when you're 70 and a half, that's all countable income. And in years past, you were able to deduct from your income qualifying medical expenses, assisted living being one of them. So when the House of Representatives removed that medical expense deduction from the tax law, it was really an unintentional but cruel hit to the senior population. So the National Academy of Elder Law Attorneys, serving as president, we teamed up with the AARP and utilized their Rolodex of contacts in the Senate, because we knew that we had no chance in the House of Representatives. So we targeted the Senate, and in particular Senator Collins from Maine, who we knew would be very sensitive to this issue. And lo and behold, the Senate version of the bill brought the medical expense deduction back into play. And one of the largest arguments that the Senate Republicans heard from us on this was very simple. If you lose that medical expense deduction as a senior, then as you start to take your income sources, take from your income sources, let's pretend it's the retirement plan, that distribution is automatically subject to the income tax bracket that we talked about before. So right off the top, you're paying taxes. So now you have less money to pay for your medical expenses. So if you're a senior who requires home care services or assisted living, or if you're paying privately for your nursing home expense, because you no longer would be able to deduct those expenses, the amount of time your assets will last you to privately pay for your care would be substantially diminished by the income tax bracket you are in. So by preserving that medical expense deduction in the Senate, they're ensuring that all of your money can be utilized for your long-term care expenses and not your money minus taxes. So I want to commend the U.S. Senate for putting that back in there. Now, there is a bit of a compromise. In 2017, qualifying expenses that exceeded 10% of your adjusted gross income were fully deductible. So for 2018 and 2019 in the new Act, it returned to old law, which was many years ago, where the threshold was 7.5%. So if you had expenses that exceed 7.5% of your adjusted gross income, then they're deductible. But that's only for 2018 and 2019. From 2020 through 2025, when this Tax Act sunsets, the threshold increases back to the 10% number that we had in 2017. Now, a couple of other parts of this new law that come into play that I need you to focus on but not dwell on, and that's the estate tax. This is probably one of the largest benefits of the 2018 Tax Act, is really benefiting the top 1%, and that's the estate tax. So the estate tax has an exemption, meaning if you have this certain amount of money or under, you're not going to pay an estate tax at your death. So under prior law, 2017, that exemption was $5.6 million federally. So if your estate when you die, that includes your house, your savings, stocks, life insurance values, all of your assets, if that was under $5.6 million, no federal estate tax. That number has been doubled per person. So under this new act, if you've got $11.2 million or less, you are not paying a federal tax, estate tax, that is, at your death. So just something to keep in mind. Don't dwell on that, because the majority of Americans may not be lucky enough to find themselves in that situation. But just know that that was one of the biggest drivers of this Tax Act, more so than just, as you hear on the sound bites, of the corporate tax rate reduction. The other thing I do want to mention was that the cap on mortgages, home mortgages, and again, this is something that will impact Westchester County, has been reduced from just over $1 million down to $750,000. So what does that mean? It means that if you have a mortgage that exceeds $750,000, you need to talk to your accountant as to whether or not the interest on that mortgage remains deductible or not. So we have now a $750,000 cap. So if you're under the $750,000, your mortgage interest is deductible. So it's sort of a double whammy between the state and local tax cap and the mortgage interest deduction cap. There will be some corresponding impacts for seniors and those that live here in Westchester County. So definitely meet with your tax advisor before this year is out to understand the impacts of this on you. All right, now let's move into some areas where I want you to talk to your attorneys and your financial advisors with regard to how you can help save in tax dollars while at the same time you're doing necessary estate planning. So as part of the new law, there are 4 brackets for trusts and estates. There's 10%, 24%, 35%, and 37%. Much less number of brackets than for the individual. So for those of you that are creating any sort of trust in your planning, whether it be your home, if you want to try to protect your home from any expenses in the future, you want to make sure that you talk to your attorney about qualifying that trust as a grantor trust. That's the type of a trust that is a product of the tax code, which means effectively that for estate purposes, you're no longer considered the owner of the asset. But for income tax purposes, you still are considered the owner of the asset. Why is that important? Because then if your trust happens to be a grantor trust, you've just expanded the tax brackets that are available to you, which are the individual rates, the 10%, the 12%, the 22%, the 24%, the 32%, 35%, and 37%. So you can have a built-in tax savings if you qualify that trust as a grantor trust. A couple of other areas that could be quite helpful. You know, we all hear that when we die, our beneficiaries may get a stepped-up basis in the assets that they inherit at your death. So let's just focus on the home. Let's pretend you bought that house for $30,000 years ago, and today that home is worth $630,000. That's a built-in capital gains of $600,000. Your cost basis, so when you purchase the home, versus a fair market value the date of your death. If the trust is structured in a way that can assure that stepped-up basis from $30,000 to $630,000, then your beneficiaries won't have to worry about paying a capital gains tax if they sold that asset for fair market value at the date of your death. How could that be accomplished in a trust document? Well, there's something called a limited testamentary power of appointment. It's just a very fancy way of telling the world that you're reserving the right to change your mind as to who your ultimate beneficiaries will be of your trust document. So, for example, let's say I've got 3 children, and in my trust, I give a third at my death to those 3 kids. If I had another provision in that trust that said, you know what, I want to reserve my right to change my mind as to whether it is in fact going to be my 3 kids as beneficiaries or anyone else other than myself, the creditors of my estate, or my spouse. That's what a limited power of appointment does. And by virtue of just reserving that power, the asset that I put into that trust, in our example, the house, would then enjoy the benefit of a stepped-up basis at my death, because if I reserve that right, then that asset is still part of my taxable estate when I do pass. And then the beneficiaries, whether it is those 3 kids or anyone else or a charity that I may choose, will not have to face a capital gains liability if they sold it at my death, that asset. So that's something I do want you to consider. Also, when you are meeting with your advisors or your attorneys about any kind of irrevocable trust that may involve your home or other assets as part of your planning, I want you to talk to them, especially if it's your house, talk to them about how you can preserve any senior exemptions you're currently getting on your property. Enhanced star exemptions here in Westchester County, veterans exemptions that you may be getting on your property. That trust needs to be drafted in a way that effectively gives you a life estate in the property where your use, occupancy, and possession of that property is exclusive to you. And if that is done, then your advisor may be able to help you retain those exemptions. So your planning process as a senior can continue without fear that you're going to face an increased tax liability by virtue of doing the planning that you are doing. So those are some nuggets that I want you to keep in mind But probably the most important one, and we talked about this earlier, is in fact that medical expense deduction. Now, talk to your accountant about the requirements to make sure your medical expenses are in fact going to be covered and protected under this new tax law. What records do you need to keep? What types of long-term care services actually qualify for that medical expense deduction? A couple off the top: nursing home expenses, assisted living expenses, home care expenses, any other medical expenses that qualify for long-term care will in fact help you reduce your tax liability. But please check with your tax advisor so that you have the adequate records in place to ensure that you qualify for those deductions. Now, I want you to remember again, this tax law is not permanent. It is permanent for the corporation, but it is not permanent for the individuals. With a sunset provision in 2025, we all need to keep our eye on the ball when you're doing planning. You may decide to do planning with an attorney or financial advisor now to take advantage of any possible opportunities that exist in this tax law. But don't just rely on that for the rest of your life. Be certain to revisit your planning, say 3-4 years from now, before this act sunsets. A lot's going to happen. We have midterm elections coming up in November. That may change the landscape. That may change the landscape in terms of whether or not this tax act will continue as it is, whether other deductions will come back in, whether the state and local tax deduction may be increased again. It all depends on who retains control of Congress. And then in 2020, 5 years before this act sunsets, we have another presidential election. And you need to be mindful of, during the election cycle, what you're hearing about the possible impact in taxes. Most politicians out there will promise, we're going to cut your taxes. I want you all to start focusing on your deductions. Hear if any of these candidates that are running this year in 2020 are talking about increasing your medical expense deduction, or if they're talking about the state and local tax deduction. Those are important to you from a real-life perspective, as you'll learn when you talk to your tax advisors, as to the impact on your bottom line on your tax return in April. So the best piece of advice I can give you is do not sit home and wait. Get on the phone, call your accountant or tax advisor, and really understand how this will affect you in April of 2019 when your tax return is filed, so you're not surprised. So you can start planning now. If you need to save more money towards your tax bill, start saving that now so you have it in April. Okay? Probably the best piece of advice I can give you with regard to this. Yes, it is a complicated law. It does affect us in many different ways, but please seek out a qualified tax advisor, qualified tax attorney. If you want to find an attorney that should be knowledgeable in this area, I invite you to go to the National Academy of All the Law Attorneys website and just find an attorney in your local area. One of the things that the National Academy of Attorneys pride themselves in is the fact that they do have a working understanding of these changes and how they affect seniors and those with disabilities. So with that, I want to thank you very much, and I hope this has been a helpful presentation to you. And I also want to thank the Westchester County Department of Senior Programs and Services. They do a fantastic job, and I know we do have our Senior Law Day coming up in October. I'll be there, and I look forward to seeing many of you come to that session. I'll probably be talking about taxes and trust again, like I typically do there. All right. My pleasure to speak with you today. Thank you so much.